We'll begin with a review of some conventional investing wisdom. Here's a common approach: buy low, sell high. On the surface, it appears to be a sound strategy. We all like to find bargains, but in the stock market, your probability of success is far better if you buy high and sell higher. Now, this might sound counterintuitive, but here are the facts. In our studies of the greatest stock market winners from 1880 to the present, stocks making new highs tend to go higher, while stocks making new lows tend to go lower. You want to buy stocks that are at or near their 52-week high and that are leaders within leading groups, and only buy stocks during a confirmed market uptrend. You want to avoid low-price stocks, which are typically shunned by institutional investors like mutual funds and banks. We suggest to only buy stocks with a price of $15 or higher. You don't want to buy cheap. You want to buy right. Here's another familiar strategy: buy on the dips. This is one you might have heard from pundits in the media. But our research shows your probability for success in a trade is far greater if you buy on the way up. Buying on dips can be a very dangerous strategy. Many people who are buying on the dips are chasing a leader during its decline phase. Here's a key fact. Once a leader tops, the average decline is 72%. That's huge. And most will never come back. Here's a classic example of how dangerous buying on the dips can be. Here's Yahoo in January 2000. One pundit said, "Over the near term, don't sell positions. Stay the course. Look for dips." Then another said, "It's not prudent to chase Yahoo at these levels, but rather to buy on dips." If you had bought this stock on the dips and held it, you would have suffered a 97% loss in 20 months. Here's another one you hear quite a bit: buy and hold. Usually it's referring to big, well-known names that are considered to be safe stocks. Let's take a look at a classic example. Here's General Electric, a well-known blue-chip stock that many consider to be a must-own. Had you bought it 10 years ago, you would be down about 68%. Not a good return on your investment. Our research shows that a better strategy is to buy a leading stock and only hold it for the duration of its run. And here's an important fact. A leader's run, on average, only lasts 12 to 18 months. All too often, buy and hold means buy and forget about it. But as you just saw with General Electric, that can be very costly. The conclusion? Conventional approaches may work some of the time, but investing with a fact-based system with history-proven rules will increase your potential for success. Remember, facts and research always trump conventional wisdom. So let's take a look at the CANSLIM system for investing, which is a proven fact-based system. It was developed by William O'Neill, chairman and founder of IBD. This simple strategy was derived from an extensive analysis of all the greatest winning stocks of the last century. Our studies found that these great stock market winners shared 7 common characteristics, and CANSLIM stands for those 7 traits. Let's review these traits. C stands for current earnings. Look for stocks with increases in current quarterly earnings of at least 25%. A is for annual earnings. Look for stocks that have grown their earnings at least 25% or more for the past 3 years. N is for new. Studies of the great stock market winners of the past all had something new. A new product, a new service, new price highs, or a new condition in the industry. One other important factor is to look for newer companies. Our studies of the greatest stock market winners showed that 75% of them went public within the last 8 years. S stands for supply and demand. This is a basic law of the market. As more investors demand the limited supply of shares, a stock's price goes up. L is for leader. We are always looking to buy leading stocks in the leading industry groups. I is for institutional sponsorship. Professional investors like mutual funds and pension funds account for about 75% of all market activity. Using IBD and investors.com, you'll learn how to follow the big money. And finally, M is for market direction. Although last, it's the most important. Why? 3 out of 4 stocks follow the general market's trend. You always want to trade in sync with the market. Here are some great examples of market winners of the past. Look at these price gains. Whether it was Northern Pacific in 1897, Syntex in 1963, or First Solar in 2007, all these great stocks shared the 7 common traits of the CANSLIM system. How well does the CANSLIM system work? An independent study of over 50 leading investment strategies by the American Association of Individual Investors found that the CANSLIM system was the top performer in all categories.